Thanks for the intro, Gary. Appreciate it. And thanks for having me on here. Yeah, for those of you who don't know me, I actually was one of the first agents in FFL. I mean, my Americo number is 45. And I was the only carrier then. So I was the 45th person contracted with America when we first started this company. And I think 40 of them are no, the 40 in front of me are no longer here. So there's probably five people that have been in the business with us longer than me. And that doesn't say much, but it does say one thing, and it's kind of in line with what Gary was just saying. You know, when you're having a bad day, a bad week, don't quit, because there were so many people that we started this company with, and it was not nearly. I mean, it couldn't even compare what we had to deal with what you guys have now. You know, and it was rough in the beginning. And there was a few people that I remember that were incredibly talented that got punched in the mouth and they quit. And I guarantee it, don't know where they're at right now, but I guarantee it, almost all of them would trade places with me, option. So I think when you get into a business and you know the business model has been proven, and there's some people that are incredibly successful. I mean, not just a handful. I mean, there's thousands of people that are incredibly successful. It's just a matter of time to figure out you just need to figure out your path to get there, because it's possible. We all have the same tools, we all have the same playing field. The only thing is certain people get punched in the mouth, have a bad week, a bad day, and they quit. And other people withstand that, and those are the people that become incredibly successful, because it's not even based off of talent, because this doesn't take a whole lot of talent. It takes about caring about people, which I guess would be a talent. It takes a lot of drive, which would also be talent. But I'm not smart. I mean, I was broke at 40, and you're not broke at 40 by making good financial decisions. And now here I am training on finances, training on retirement, and people trust me with millions and millions and millions of dollars, just because I have an understanding of what the products are that we have. And they're really simple. And they had to be for me to understand them. And so when I first started off, you know, like I said, I was flat broke into this business, and I was really intrigued by the quick turnaround about simplified issue life insurance, where you write something, get paid a couple of days later. I like that a lot, because when you don't have money, you want it quick, you know. And so I did that part of it, but also I was going to every training that we had, and there's a guy next to me that came out of his shoes, because he got paid on an annuity, and it was 63,000 is what he got paid. And I was new to the business, and I saw, saw his deposit for 63,000, and I just thought, dear Lord, what would that do for my life right now? Because I'm just getting started, and it would have changed everything for me. And so I made it a point to go out there and learn as much as I could about annuities. I was on every training, I was reading online, I was doing everything I could to expose myself to these products. I had a basic understanding that they protected retirements, and I like that part of it, but I also like the financial part of it as well too. And then I started looking for the money, and I found a lot of it. I did a lot of presentations, and to be honest with you, I was god awful at first. I was terrible, and the reason why I was terrible was because I felt like when we have these 27-page illustrations, that I needed to go over all 27 pages with the clients. I needed to tell them everything I knew about annuities for them to fully understand, in order for them to make a decision on whether they wanted to move forward with me or not. And I was not only confusing the clients, but I was confusing myself along the way, and there's a lot of information in there. So after about nine presentations and not be able to, help anybody with their retirement, because they all wanted to think about it and call me back, which I never heard back from them. I had to look back and think what I was doing wrong, because I saw other people were able to help their clients and I wasn't. So what am I doing wrong? And I just saw it as, okay, so what are the questions they're asking me? What are they concerned with? And so they were concerned with, they didn't want to lose any money. They didn't want to outlive their money. They didn't want to pay high fees, but they still wanted to get a decent rate of return that was going to outpace inflation. And so when I started focusing on just those four things, with each client, understanding what their specific fears were, what their concerns were, what their goals were for their money, and then finding the right product and explaining how it's going to address those things with them, then everything just flipped around for me. Then it got easy because now we're not selling something to somebody. I don't consider annuities to be sales in any way whatsoever. I 100% consider them to be solutions because we have 10,000 people, over 11,000 now, 11,000 people in the United States retiring every single day. And 53% of these people don't feel like they have enough money to last them a lifetime. And so if they don't have enough money to last them a lifetime, when they're hanging up their biggest financial asset, which is their earning potential, how do they make what they have last longer? Well, the first way you make it last longer is you eliminate the downside, you eliminate the losses, and still get some substantial gains over time. And so when I started addressing the client's concerns and matching up with their goals and what they needed, it became really easy because I was just providing a solution. And the best part about our solution is that we're the only ones that have this. Financial advisors don't have it. Banks don't have it. Their neighbor that gives them financial advice, they don't have them either. And so we're very, very, very unique. We have a product that fits what most people are looking for in retirement. But the only downside is only 4% of licensed life insurance agents sell annuities. I thought it was just in our company. It's not. It's just we're so transactional in what we do and selling life insurance and final expense and IULs and all those other things that we don't go out there and we don't look for these other opportunities. Because the crazy part is you guys all are talking to people all day long that are great opportunities to help them with their retirement. We just don't take advantage of it. And by not taking advantage of it, we're doing them a disservice as well too. I think it was a month ago, someone referred a guy to me that he had $400,000 in his 401k he was looking to do something with. He just bought a whole life policy from somebody at another agency. They never asked him about his retirement. He just retired and he had $400,000. He's looking to put it someplace safe, and they didn't ask him. And so he called in and he had a question about his current policy. He called in and he happened to mention about I got this 401k that I need to place. And now we helped him with that. And so it's like that happens all day long. We're talking to people that have funds. And so I do have a little bit of slideshow to walk you through. I put it together for training last week, and it kind of gives you an idea of. I did it for like an annuity 101 type thing, kind of breaking things down from the very beginning stages of it. So what I'm going to do is I'm going to go through that slide. It's going to cover a lot of information you guys might be wondering about. It is at a high level, not high smart level. It's at an easy level to understand, but it gives you what annuities are, who our target audience is, and why the market's so good right now. So it's going to take me less than 10 minutes to go through that. And then I can answer any questions you guys have because I think it's going to cover a lot of things I usually already discuss anyway. And can I share my screen? Yep. All right. You guys see that? Gary, nod your head.
Yep.
Got it. Okay. Let me move this out of the way. All right. So I get asked all the time, what is a fixed index annuity? Now, annuities have been around for a very long time. Ours are better than all the rest. Ours are fixed index annuities. So what is a fixed index annuity? It's a contract with an insurance company that pairs principal protection with market-based growth. So their principal is protected, but you still participate in the gains of the market. It's built for long-term retirement money. With an income rider, it can pay a permanent income for life. So you can turn it into sort of a pension. So the principal protection side of it protects the downside market, or the down market's credit zero. So if the market goes down, they're not going to lose any money whatsoever. The account value never drops below what they've rolled into it, what they've accumulated, and never declines due to market loss. That is the biggest selling point of what we have right now, especially in today's market. The markets are at an all-time high right now. Could they creep up a little bit higher? They could, but statistics say we're due for some sort of correction. When we're talking to clients, why not take all your growth that you've gotten and remove the risk from a part of what you have? And that way, when the markets do correct, whenever that day comes, you don't lose any money at all. The market-based growth in the middle here, that's the upside potential is linked to certain indexes. And that's how these products have gotten so strong lately, is we've got more indexes to drive interest rates, and the amount of interest that gets applied to the accounts is higher now than it's ever been. The participation rates, how much of the growth we participate in, are higher now than we've ever been, which means substantially more interest for the clients. So we have the protection of no downside risk and some substantial returns based off where the market is now with its high participation rates. And then we can also turn a lump sum of money into a lifetime income. If we have a product that has an income rider on it, we can turn it into a pension. The retirees' fears are outliving their money. They never want to outlive their money. Here's a great way to never outlive their money. And with so many companies doing away with long-term care products, they have on the income riders, they have a multiplier where if they're getting a set amount for income for life, if they have to go into a home and they can't do two of the six acts of daily living, they'll double their income for up to 5 years. So it's a great way to kind of offset some of those medical costs that come up later on. So you have the principal protection, the market-based growth. We can also have a lifetime income rider to it that's going to provide them that pension, that Social Security. That money is never gonna stop until they die. And so it's written down here. It says our clients are more savers, not gamblers. And I think the biggest mistake a lot of people make is trying to find a client that's not a good fit. So our clients are going to be savers, not gamblers. This is a product that lets them grow without the fear of any losing whatsoever. And if you think of somebody who has just retired, that peace of mind of my account's going to grow, but I don't ever have to worry about waking up, turn on the TV, seeing these red numbers going across the bottom of my TV, wondering, is this just a bad day in the market? Is it going to be a bad week, a bad month, or a bad year? This eliminates all that risk from happening, all that anxiety that comes with that as well, too. So why should we be writing annuities? So there is a massive market right now, and a renewing market every year. There's 4.1 million Americans retiring every single year, and they all need safe money. Advisors don't have our products. Most of these 4.1 million Americans that are retiring, they go to financial advisors that try to do the best that they can with the tools that they have. They'll put some money into bonds, which is going to keep that money safe, but it's also going to limit the growth that's over there. They'll keep some money in equities as well too, which is going to give them that upside potential to get some growth. But anything that has the ability to grow like that has the equal ability to lose. They don't have something like us that 100% of it is safe and 100% of it grows when the market does. And 4.1 million Americans retiring every single year, the market is massive out there. And then the removal of fear. These products erase the financial stress and anxiety that keeps retirees up at night. I can't imagine having a certain amount of money and seeing the market going down and then thinking, how do we adjust our lifestyle? Does one of the two of us go back to work? What do we cut back on? Because if you have a finite number that you're working with the rest of your life and that number starts to dwindling because the market's going down, you've got to make some changes. It's either people working longer, going back to work, or cutting things out in their life that they didn't think they'd have to. They thought they had enough finance to do it, but with a decreasing market and declining income, they may not be able to afford some of the things they're doing right now. Your client's already qualified. You're sitting across, you're talking to people every single day that have dormant 401ks, that are retired and have IRAs, have large sums of money in their checking and savings account. It's the same conversation. It's just asking a question later on to uncover those funds and start that conversation up. Also, I don't lead in with this. The pay is excellent. The average commission on annuity is about $8,400. The chargeback rate is less than 1%. I've had one chargeback in my entire life. And that guy tried to get me to rewrite it later on, and I wouldn't. So the average commission is about $8,400 on each one of these. And the physical time, the keyboard time it takes is about 40 minutes. It's not that long. I do a pre-phone call, 5-10 minute phone call with them, kind of give an overview of how it works. I set up a Zoom, I go over an illustration, I highlight the illustration, I send it over to them to review and look over and come up with some really good questions. And then we meet again, answer any questions, and write the application. The whole process on the keyboard on time takes about 35 to 40 minutes. The average commission is $8,400. I helped a guy last year get a really big one closed. His commission was $347,000. Just before that, I helped another guy with some agents or clients that he had, and we split 172,000. So the numbers can get pretty sizable. The commissions can be pretty large, but overall the average is about 8,400, and that's money you get to keep. And so the last thing here is it helps fund your business. Agents who write annuities don't carry debt. Agents who write annuities are more financially sound. They're able to put more money into their business by buying leads, hiring staff, opening offices. And why should your agency want people in your agency writing annuities? Because they don't roll debt. I built my agency and I trained from day one. I sold to integrity based off of the fact that we wrote a lot of annuities because I never had any debt rolled to me. So I got, not only did they get to keep their money, the agents did, I got to keep my money because I didn't have debt rolled to me. So when you build a financially strong agency by including annuities into them, you can actually grow a bigger one because you get to keep the money as well too as a manager. All right. So who are we looking for? Who is our target audience? So our target audience is going to be people in their 50s, 60s, and 70s. People who are thinking about retirement or already there. They tend to be savers, not investors. They want safety and certainty, not risk. So if somebody comes to me and says, hey, I want to get the highest rate of return, can you beat this, this, and this? That's typically not who we're looking for. We're looking for people who have spent 20, 30, 40 years putting away for their retirement, and now they want to enjoy that money when they are retired, but they don't want to risk losing it. So, like I said, we've got 4.1 million Americans retiring every single year. 53% of them have said, I don't have enough. I didn't save enough to last me a lifetime. That means 2,173,000 people know they can't afford to lose a dime because they didn't save enough to last them a lifetime. So there's over almost 2.2 million Americans that are perfect clients for our products. There's more than that, but these are the ones that just raised their hand and said, I didn't do a good enough job to last me a lifetime. I can't lose anything at all. And we're talking to these people every single day. And so if you think of that's every year. So think of a 3-year time frame. In the last 3 years, there's been over 6 million people that have retired, and or 6 million people that have retired and know they don't have enough money to last them a lifetime. And so this chart here, for anybody who's been around forever, like I have, I started using this chart early on, and it's outdated. It was at last updated in 2013, which was 13 years ago. But I still to this day believe, for those of you who don't understand how annuities work, I used to bring this to me with every appointment to show my clients how these worked. And so the way it works, let me see if I can do this here. I don't know if I can. Maybe I can. All right. So what this is $100,000 deposited in, forever ago. Some of you probably weren't even born then, 1998, right? $100,000 deposited into the S&P 500. That's going to be the red line. A fixed index annuity, which is going to be the green line, and a fixed annuity, which is the blue line. We're going to ignore the blue line because we're only talking about the green and the red here. So what it's showing here is the market volatility of the S&P 500. So the S&P 500, $100,000 deposited in 1998. By year 2000, you've got 100. Right here, you've got $136,000 in there. That's awesome after 2 years, right? The annuity didn't do so great, but still did pretty good. You've got 120,000, 125,000 on the annuity. Now, this is an annuity from 2013. This is not ours. Ours blows doors on this one. So this growth would be substantially higher. I'm just trying to show you conceptually how these work. Okay. So after 2 years, S&P 500, top 500 stocks in the U.S., you've got 136,000. You put in a fixed index annuity, you've got 125,000. So a little bit less than that, but still some good growth. But then we saw the market crash of 2000, where the markets lost 43%. And so now in a 2-year time frame, that 136,000 went down to 78,000 down here. So if you think about someone who's retiring, somebody who had a big jump up in their retirement, maybe they retired in 98, and 2 years later, they're thinking their market's doing great. Look how much I've grown. This is awesome. This couldn't be any better. And then over the next 2 years, they lose half of that. That stinks. Those are the people we're trying to save right here. These are the people we're trying to protect. So this does not happen because these people are definitely going back to work. These people are getting second jobs. These people are cutting back on their quality of life because they don't have enough money to last them a lifetime. They didn't before, and now they definitely don't. Our product just slides right over. So 125,000 in 2000, in 2022, still 125,000. We didn't lose anything at all. But the next 5 years, the S&P 500 climbed back. So it climbed back to just a hair above where it was before. Same thing with us. We didn't lose anything, so we're not recovering. We're compounding on the amount that we rolled in and the previous interest that we've had applied. So we're growing at a higher rate because we're not recovering. We're just growing. And you see here in 2007 for the market when it peaked again, they got 145,000 there. That only lasted a year before another market crashed and brought it back down again. Well, we didn't have that crash. We slide right over. So now after 10 years, they've got 100,000 right where they started, and we've got 156,000. So our big years are not going to beat their big years, but slow and steady wins this race. That's why we're looking for savers, not investors. We want people that want to get off of this ride, all this volatility, stop losing money, stop losing sleep, and just put it in something that's going to grow safely over time. And then you see another jump up here towards the end, and the markets have gone crazy ever since then. I don't have a chart. I did have a chart that tracked it to now, and it's still, they knew they actually did better over time by limiting those losses. But you can see here that from 1998 go to 2013 here, we only had two peaks, 2 years where the markets were completely up. Still not touching where the annuity was after a while because we had that steady growth and no losses. But everything else in between there is volatility. And when you're retired, you don't want that volatility. You don't want to wake up and guess where your retirement is that day. And so we have a product that eliminates all that volatility, all that anxiety that comes with that. And if somebody's in their 20s and 30s and 40s, that's fine. They can ride this up and down. 50s, 60s, and 70s, when you're looking to retire or retired, this will give someone a heart attack. This will cause the financial stress of a married couple thinking, what are we going to do? You know what? They're looking for a way out. And that's why when we explain our products, they don't know these exist. The number one comment I get is, why isn't everyone doing this? Well, the reason why everyone's not doing this is because we do a poor job of presenting this to our clients, looking for those opportunities and presenting it to our clients, because only 4% of us are actually selling these. So how do we uncover the funds? You know, the one thing I always tell people is we are not trying to disrupt your life sales in any way whatsoever. You know, my top agent did a couple of years ago, he did 10 million in annuities and he did 650,000 in life. And so he didn't have to disrupt his life volume to write 10 million in annuities. But it's, you know, when you're on the phone and you ask them what life insurance they currently have in place now, and you ask them right afterwards, what else do you have that would act like life insurance? Any IRAs, 401ks, annuities, or anything else that would be transferable upon your death? You know, you're looking to protect the family. So you need to know what else they have. So you ask about the life insurance, you ask them what else do you have that would act like life insurance, and then they tell you. And a lot of times I wrote annuities for people I did not write life insurance for. And a lot of times they show me their assets because they're going to show me they don't need my life insurance. Well, say they've got $250,000 in an IRA, and I just write the 250 down. I don't address it at all right then. I finish what I'm there for, whether you're there to sell an IUL, final expense, you know, traditional mortgage protection, whatever it might be. You wrap that up, and just before you get off the call, it's like, hey Gary, in regards to this $250,000 you've got in this 401k, how much of this could you afford to lose if the market were to take a turn? And if they're a retiree, they're going to say nothing because they can't afford to lose anything. Okay, great. I don't have any time right now, but would you be available Tuesday for about 10 or 15 minutes to learn how to eliminate all the losses, all the volatility, and even reduce or eliminate the fees you're currently paying right now? Who's going to say no to that? I don't say I've got an annuity I want to show you. I just said, hey, would you be interested in learning how to eliminate the losses and all the volatility from your retirement account, as well as lowering or limiting the fees you're currently paying? Most people say yes to that. And so then you set an appointment. You don't need to get into a conversation. I've got this fixed index annuity. It's better than what you have. None of that. Just set the appointment. And if you're savvy and you can run the appointment by yourself, awesome. If you need some help, reach out for help. But if you start asking these questions and reaching out for help and you see how simple the process is, you'll be shocked. Because when I do my presentations, everyone thinks because I sell a lot, there's going to be like laser shows and all these great things. It's not. I ask the client some questions. They tell me what their concerns are. They tell me what their goals are. I show them something and they usually say, okay. And, or why isn't everyone else doing this? The process is really simple and the money's really good. So why is now the best time to get into the annuity business? Like I said, the clients are endless. We have 4.1 million people retiring in the United States every day. The market volatility right now is a head scratcher. We'll gain 2% in a day. We'll lose 3% the next day. There's no rhyme or reason for the markets to be where they're at right now and why they're going. We're 38% overvalued, meaning that if the stock got adjusted to the value of what their companies are, we lose 38% off the top. The last time we were this overvalued as far as stocks to earnings ratios was back in 2000 when it lost 43%. Am I saying that's going to happen? No, I don't know, but I don't know it's not. It's a really weird time. The market is moving one way or the other based off of announcements, and they're not financial announcements. It's, hey, the war is over. Hey, the war is not over. Hey, we did this. And the market react so quickly. So why don't we remove that volatility, remove that anxiety to a portion that you want to save? Because the markets with technology nowadays, when they go down fast. And by the time someone realizes they're losing their retirement and they want to make a call to move to something safe, it's usually too late by that point. And also, the third thing is the products are better than ever. These products are the strongest I've ever seen. The accumulation is stronger. The bonuses are stronger. The indexes are better, more diverse. So they're getting more consistent growth and they're getting higher growth. And they have these massive bonuses to roll over and give them a jump start. I used to not talk about the bonuses. I can't not talk about them anymore because they're so large. So when we have the products are designed right now and built better than they've ever been, and we have endless clients and we have market volatility, that those three things combined, you guys can write your own ticket with these as long as you just start looking for the money and just be proactive with that and be consistent. And I always get asked what carriers I use. I use Athene a lot. I use North American too. I'll use NLG in certain circumstances, and Americo just came out with one that's really good. Those are for the growth annuities. For the income annuities, F&G has a really good one if they're starting their income in the first year or two, and then Athena or North American if they're going to defer the income out a little bit. So it says here, go right into it, protect your clients, pay yourself as well, build a business that lasts. Ask the golden question on every appointment. We're looking for savers in their 50s and 70s. You're talking to them every day. Match the carrier to the goal, growth or income. And it's pretty simple from there. That's something I just kind of threw together. So hopefully that, given that visual helps rather than just seeing my bald head talk forever. But these are really simple products. They protect. Your clients are looking for these. They're desperately looking for these. I had two meetings already this morning. It's 8:34 at my house. I had one at 6 and I had one at 7. And both clients are just shocked that we even have something like this. They don't know it exists. And there's so much bad information out there. Fisher Investments, their whole marketing campaign is annuities suck. Run away from them. Well, why do they suck? Oh, they have high fees. They have market volatility. They have all these things. They have all the things that we're not. And so what we need to do is find clients in the target audience, 50s, 60s, and 70s, ask the right questions, uncover some funds, and show them what these can do and let them make a decision from there. And if most of the time they're deciding that I want to take this off the table, I don't want to gamble with my retirement anymore. I want to take this off the table, remove it, but then still, like I said, the products are built better now than they've ever been. So that upside potential is enormous. And I love seeing, I had a guy I wrote 3 years ago that he wouldn't even, this is when we're doing face to face, he wouldn't even come to the living room to talk to me. His wife set the appointment. He sat there with his arms crossed in the kitchen. And I just told him, I said, his name was Wade. And I'm like, Wade, I want to go home, but I can't come home until you sit with me for 5 minutes. So will you please let me go home? And they came and sat with me for 5 minutes. We ended up writing 300,000. They just passed their third anniversary. That 300,000 that he rolled into me is 468,000 now. And that's his floor. Never go below that. So Wade's really happy that he uncrossed his arms and came and sat and had a conversation with me because he's safely going his retirement. And wouldn't happen if I didn't push a little bit, but it also wouldn't happen if I wasn't comfortable and confident in the products that we have to explain to him and then let him make a decision. There's certain people out there that still think the world is flat. Some of you might, I don't know. So you're not gonna be able to help everybody. But it's the people who work really hard for their money, 20, 30, 40 years in the business, put away for their money that they have, 50s, 60s, and 70s. They're looking to retire, they're retired. We have the only product out there like this. The competition is ourselves. The competition is getting out of our own head, asking these questions, having the conversations, and then showing the illustrations and letting the clients decide whether it's for them or not. So I got
So
time for
good.
some
So
questions,
so
Gary, if you have
good,
some.
John. So good. One question came up last week. You do the golden question, you kind of see that they're interested into it, but you have to do a kind of like a follow-up question. And the question is what's the interest rate, or what's the rate of return, or why is it better? Can you talk a little bit about the bonuses and how somebody, without selling too much, getting the second meeting, given a person an idea about what's potential for bonus, and you have 400,000 in your account, you could potentially do this, and you can see 460 the next day. How do you word that?
I typically don't, to be honest with you. What I do is ask. Everything's about asking questions. So, okay, so Gary, you've got this $400,000 in your retirement. What do you have this earmarked for? Because I don't want to show them something they're not going to be interested in and shoot myself in the foot. So, what do you have this money earmarked for? Is this something that you want to? Are you fearful of running out of money? Do you want to generate lifetime income? Maybe they don't. Maybe they know I got pensions and I've got Social Security. I'm totally fine there. Okay, is this something that you want to leave as a legacy? Yes, I want to leave as a legacy, leave to my kids. I want to make sure they're taken care of because I'm fine. So I find out what it's earmarked for and how they plan on taking their distributions before I even talk about the big selling points of it. And then I'll go into it and I'll say, well, great. If you are afraid of outliving your retirement account, we can actually turn this into lifetime income that you can never outlive. You can, if you live to be 117 years old, you're never going to drain this account. It's always going to pay out. It's got some other bells and whistles that come along with it, but I'll put that all together in an illustration. If they say that they just want it to grow safely, then it's okay, great. It's 100% safe from market loss, just as safe as your checking, savings, money market. You can't lose anything, but the upside potential in today's market is enormous. And I always throw in there, I never, ever, ever lead in with a bonus. Hey, I got this bonus because it just seems like a trick, right? It's like, hey, when are we going to give you something free? And so just so you guys know here and have a better understanding, and that's why I approach it this way, is the bonus is not free money. The bonus is upfront interest, is what it is. And so if you have a big bonus product, you typically have a little bit lower participation rates or caps, which means the average rate of return over time is going to be a little bit less. They're giving you this bonus sort of like interest upfront, which in a lot of cases is a really good thing because we can't guarantee that the markets are going to go up. So having a higher participation rate or having a projected higher rate of return doesn't come to fruition all the time if you have a couple years of a down market. So I would, especially with older clients in their 70s, I'm almost always going to the big bonus ones because they've got less time to build up. They're already using their retirement accounts. Let's give them this upfront bonus so they're getting this giant jump start from where they're currently at, and they're taking the withdrawals, right? If someone was a little bit on the younger side and don't plan on touching it at all, then we might go with something with a lower bonus or no bonus to get those higher participation rates and higher growth over time. But to get back to your question on how I lead in, I ask them what they have that earmarked for, how they plan on the distributions. Are you guys going to be taking, distribution for vacations systematically whenever you want to pull from it? Is it something that you have a set amount you're going to need each month, to pull from it? So I get a goal for that. And then I just kind of talk about the features that it has for that. Well, great. You're gonna have up to 10% you could draw each year. Oh, and by the way, they do have these large rollover bonuses they attach to them. And I always joke around saying I used to not talk about them because I don't like the word bonus. It seems a little gimmicky to me, but they're so large I can't not talk about them. But it's going to give you a jump start from where you're currently at right now. They're averaging about 20% depending on your state. And so I feel like if I lead in with that, it's almost like a trick. But if I talk about what their goals are, how they plan on taking their distributions, whether they want the lifetime income or just pull from it when they need to, we'll establish the strength of our product for that. And oh, by the way, they still add these on top of it, which is a little bit, they just do. And so I just did it that way because I just personally, I felt like if I led, oh, you got this bonus that they're going to give you. Well, stop. We're talking about money here. You
Well,
know,
that's so good. You're basically qualifying first before you spill all your guts, right? Yeah.
Yeah,
Yeah.
100%. And
Yeah.
then, I get them interested and they're pretty interested. And then you hear, oh, by the way, we're going to add 20% to your account. So I'm not leading in with that. I sort of do that at the end when I'm setting the appointment and locking it in.
Awesome. Let's take three questions, guys, so we can move on with our day. Does anybody have any specific questions for John?
Yeah,
I
I
have
do.
a really quick question.
You go ahead.
Sorry, Chris, real quick.
Now you
John, for a new agent that is studying annuities, would you recommend anything in particular that they should study? Since our last conversation, I have created a whole lot of different things for myself to study. But what would you recommend a new agent studying to get more familiar on the annuities besides the terms?
I would study finding a client. And the reason I say that, Leticia, is that because I did that. I studied and studied and studied, and I Frankensteined my my picture of what annuities are in my presentation because I had all this information. You will learn more in one presentation with a client than you will in 30 hours of studying. So I would focus on getting a client and seeing that process go through, and then you'll have a better understanding of how these work. You'll see the presentation to the client. You'll see the questions the client asks. That will give you more information than studying for the next 20 hours. Does that make sense?
That makes sense. Thank you, John.
Yeah, because it makes it applicable. Because it's just like studying to get your test, to get your license. Could you study for the license and then the next day go selling? No, because you have too much information. It's book information. Well, we're talking about what's applicable here with human beings and real money. So if you see that a presentation done, you'll learn a lot more than you would by reading the books, getting the terminology down, and all those other things.
I think that'd be appropriate now at that point, John, to share how you work on a team with some of you guys that will help them and share the deal with them on a couple where you can learn.
Yeah,
How would
absolutely.
they, if they have one, how do they reach out to you, or what number do they reach out to? Where do they go to get that help?
So one of the things that I've been doing, I've been doing this for several years now, is I've been helping people when they find the clients that I do everything. I mean, I just got done with one last week, and I don't know if they're on your team or not. I don't think they are. But this girl sent me a text saying, "Hey, I've got a call with somebody at this time. Can you help with an annuity?" And I said, "Sure." So then she told me she couldn't be on the call, so it was just me and the client on the call, and it went pretty well. And then it's okay. I set another appointment up to run the illustration and sent the meeting link to the agent. She said she'll be on there, and then she was taking inbound calls, and she couldn't get on that call either. So I just met with the clients, went through the illustration, and then the second meeting that we had was to answer any questions and do the app. And unfortunately, she had inbound calls and couldn't get on that one either. And then I wrote the application, and so she did nothing, which is fine, but she learned nothing. She didn't want to. She was making money while I was making her money. And so we split that deal 50-50. All she did was basically give me a name, a number, and a time to call these people. And then I did everything for her. And then she got 50% of the deal. And that's typically the way I do things. If I do all of it, we split it 50-50. But my goal is not to take people's commissions. And anybody that knows me, I've built massive agencies up and increase their annuity volume, not by trying to take money from people, but by teaching you how to do this. Like, she wasn't engaged. Like, she doesn't want to learn. She just wants to send the money over, send the names over, and then get paid, which is fine. You could do that. But if you do want to learn, I spend a lot of time with agents, walking them through the process, meeting with them after the presentation, going over how it went, how the questions went, what they learned. And so my goal is to develop you guys into not just people that can write annuities on your own, but to develop you guys into agency managers that can train on this stuff too. Because there's a lot of terminology and there's a lot of little nuances to them. Overall, they're not hard, but it does take one or two times to watch a presentation done to see it and get the flow and everything. But my goal is to train more people that can help more people, not to take 50% of someone's commissions. And so what I do is if I do the whole thing, we split it 50-50. You can just be along for the ride, learn as much as you want. If you want to be checked out, you can be checked out. You can do either way. But you guys can reach out to me anytime. Best way to reach me is by text right now. I'll give you my phone number. My number is 206-793-5922. So if you have like just generic questions on annuities, if you've got a case you think may or may not be an opportunity, if you want some help with some of the word tracks, you guys can reach out to me anytime. This is all I do. I help people with annuities. I write annuities. I've got a big book of business that I work with too. But I kind of realized that this was my forte. And I kind of hung up the life sales several years ago, and kind of focused on this. And I have a very easy approach to it, which makes it easier for the agents to pick up the way I do things and then just make it their own. Like, some of the top annuity producers I personally trained, and they took some of the stuff that I did and just made it their own. And now they're selling truckloads. And so you could make it anything you want, but it'll give you a good, easy base to learn how to get into this whole process.
Okay, Bob,
Yeah,
go ahead.
thank you. John, you said no expenses in the annuities. And I know that, like you said, Fisher Investments and other investment managers talk about all the fees that are. How do you explain the fact that there are no fees? There's got to be some expenses somewhere. I mean,
For the
annuity,
client?
huh?
For the client?
Yeah, somewhere there's an expense in there. They're making money, right?
They are making money. So that's actually a good, really good question. Thank you for that. So we do have a lot of products that have zero fees. Zero fees, zero charges, nothing. And if you see an illustration, you'll see that say that someone rolled in $100,000 and they had a 20% bonus. In the guaranteed minimum accumulated value, it'll be $120,000 forever until they take a withdrawal because there are no fees, there are no charges on that product. But getting back to you on how the insurance company makes their money is that there's certain safeguards they have in place. So the safeguards are that you have limited access or limited free withdrawals on these accounts. So some are 5% annual free withdrawals, some are 7, some are 10. So if you take the most popular one we have is 10%. So they know that the client is going to leave a majority of their funds in there for up to 10 years because that's the length of the surrender charge, 10 years. Any withdrawals they make above 10%, there is some recapture of the bonus and there's surrender charges. So they're already safeguarded against any larger withdrawals outside that 10%. So they know a majority of the funds are going to be left there for 10 years. So that allows them to go on the back end, make longer term investment, buy billions and billions of dollars of preferred placement bonds to get some higher yield investments there to pay themselves. And in return, they're going to apply the interest to the account based off of how the indexes perform. So that's how they're able to do it with no charges. They're
Got it.
basically using the client's money to go make more money for themselves.
So in the illustrations, when you look at the returns, like the 10-year returns and whatever, and there's a gross number, let's say 11%, then it says net of expenses 9.95.
Well, if it's a no fee one, it'll say if just for round figures, if it's a no fee one and the interest rate says 9% gross, it'll say 9% net as well too. Because we
Okay.
literally, you seem like you're having a hard time wrapping your head around the fact there's
Uh,
no.
I, I've looked at the Athene illustrations
Which
extensively.
one?
The um, the 10-year one,
The plus?
yes.
Yeah, the plus has a charge. The standard does not. So the
Okay.
plus has a liquidity charge on there. You can opt, there's different riders you can add. The
Right,
the the PE plus, you have access to more liquidity, your bonus is higher, and you have a return to premium feature that allows the client to take all their money out after the fourth year. For that extra liquidity, they charge you 0.95%. That
right.
same product comes in a standard version with zero fees. You just don't have that liquidity rider and lower access to withdrawals.
Perfect. Thank you.
Yeah. Yeah. So
Chris,
run the
real,
standard one
real,
and you'll see
real
there's no fees on it.
last question, Chris, and please be brief because we got to do a couple more things.
Copy
So, quick
that.
question.
Copy that. John, good to see you. Happy
How you
Father.
doing, bud?
You had a good one. So my question is this. The golden question is great. You find a lump sum. That's ideal. For some people, they don't have a chunk of money put away, and for whatever reason, they can't qualify for life insurance. My understanding is that, and I forget whether it's NLG or F&G, but there's an annuity that they can pay into with a monthly premium, and we would get our commission would be first year's.
Yeah.
Yeah, is that something you ever pivot to, or
Yep.
we would
Yeah, for
ever?
sure. Yeah. It's the NLG Flex Secure Growth. And
Okay,
that if it's great for people that reach out for an IUL and maybe they're too unhealthy and they've got $300 to $400 they want to put away a month, that's a great option for them. But it's an annuity that you pay into monthly, and it accumulates over time. But yeah, we use that one a lot.
awesome. Thank you. Hope you're enjoying softball tournaments, buddy. Good to see you.
Thank you too.
It's awesome. And you guys got John's number. I want to make sure we have time for Derek, Shannon, and Andrew. Remember, this time between 8:30 and 9 was designed sometimes to have the speaker go over, answer questions, and also to be contracting questions for you guys. Questions about anything in the back office, questions about the business. Andrew put this together for us so that Andrew doesn't get these calls because he's driving people now to this time between 8:30 and 9. So what questions do you guys have today about any of the carriers, about bringing a new agent on, anything about your back office, your gateway dashboard? Anything for Shannon, Derek, or Drew, and also Derek, Shannon, and Drew. Do you guys have any announcements? Anything you want to share with us?
No announcements, Gary.
Okay.
Other than Ignite coming up in Florida, September 10th.
Okay. Awesome.
Nothing new on contracting.
Nothing new. Okay. Any
Nothing.
questions from you guys for them? They're taking their time to be on here for us, and I know things come up. Okay, then with that said, remember, if in fact you guys want to come to the boot camp tomorrow and Thursday, we need to have your name. So please reply either in here or text me. It's 408-888-4848. And I know 100%, guys, that it will be